Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at AMD.
If you find our talks useful, please consider subscribe, like, and comment underneath.
So we are looking at this specific stock today for a very urgent, very compelling reason.
Yeah.
Like, if you are watching the artificial intelligence compute frontier at all, you know this stock is exhibiting just explosive, undeniable, bullish momentum right now.
It really is.
We're talking about a staggering 155% run year to date, and as of right now, it is sitting just 4.6% below its 52-week high.
Wow, just 4.6%.
Exactly. But the core narrative here isn't just about a ticker symbol going up on a screen. It's about the entire structural scaling of the AI compute frontier.
Right.
We are essentially watching a company position itself as a vital, load-bearing pillar in the most massive technological build-out of our generation.
I mean, that is a massive run. And obviously, when you see a price chart moving with that kind of velocity, understanding the technical levels, like knowing exactly where the stock might bounce or break down, that becomes incredibly important for anyone watching the market.
Exactly. When things move that fast, you just cannot be flying blind.
No, definitely not.
And actually, before we get completely into today's stock analysis, here is a remarkably useful chart tool for investors and active traders alike.
Oh, yeah, let's talk about that.
So if you want help reading trading charts more clearly and kind of mapping out these wild moves, you can check out VIP Algos through the link below in the description.
Right.
VIP Algos is a TradingView indicator suite that actually shows visual buy and sell chart alerts directly on your screen. It includes trend direction tools, support and resistance zones, and it even gives you take profit and stop loss planning areas.
Which is super helpful.
It is incredibly versatile. It can be used across markets like stocks, forex, crypto, gold, indices, futures, you name it.
Yeah, but we should probably mention...
Oh, right. Yeah, just remember, VIP Algos is an educational chart analysis tool only. It is entirely up to you how you use the data.
Exactly.
It is not financial advice, it does not place trades for you, and it absolutely does not guarantee profits. Trading involves risk, so you must always manage your risk and, do your own independent research.
100%.
And just so you know, this is an affiliate link, so we may earn a commission if you use it, but that comes at no extra cost to you.
Awesome. So before we jump into our first major theme, let me just lay out exactly what we are doing today for you, the listener. We've pulled together a mountain of financial data, earnings transcripts, macroeconomic reports, and technical charts to answer one really pressing question.
And it's a big one.
It is.
Yeah.
Is this stock just riding a wave of speculative AI hype, or is this a structural, multi-year shift in how the world's biggest companies are spending their money?
Right.
Our mission in this deep dive is to cut through the daily market noise and extract the most important wealth-building insights from all this data.
Let's do it.
All right, let's move into the wealth-building context.
So when you are looking for long-term portfolio growth, the strategy is always to look for structural, tectonic shifts in the broader economy.
Yeah.
And right now, the generative AI build-out is arguably the most significant capital expenditure cycle we've seen since the dawn of the internet.
It's massive.
It really is. And this stock fits a very specific high-growth profile. You can kind of think of them as providing the picks and shovels of the AI gold rush.
Okay, I like that analogy.
Right, because they aren't trying to build the next viral AI chatbot. They are supplying the actual physical hardware, the massive computational engine that makes those chatbots possible.
Right, the foundation.
Exactly. So for a long-term investor, the thesis is quite compelling. You aren't betting on one specific AI software winner. You are betting on the foundational infrastructure that every single one of those software companies requires just to survive.
Okay, let me push back on that a little bit, because I think a lot of people listening are feeling a sense of deja vu right now. We hear the phrase AI gold rush thrown around constantly in the financial media. How do we know this isn't just speculative hype?
That's the million-dollar question.
I mean, are these hyperscalers, the massive cloud providers like Amazon, Microsoft, and Google, actually making a multi-year structural shift in how they spend their capital? Or is this just a temporary surge of panic buying that's going to completely dry up in 12 to 18 months?
That is the critical question, and it's exactly what separates a quick swing trade from a long-term wealth builder. And honestly, the data we have right now points heavily, almost exclusively toward a structural multi-year shift.
Okay, why is that?
To understand why, you have to look at what these hyperscalers are actually doing. They are fundamentally redesigning their entire data center architectures from the ground up.
Really, like a total overhaul.
A complete architectural revolution. Historically, data centers were built around standard CPUs, central processing units. But generative AI requires massive parallel processing.
Right.
Which means data centers are aggressively shifting toward GPUs, graphics processing units, and accelerated computing. This isn't just swapping out old servers for slightly faster ones.
Yeah.
It's a fundamental change in how the internet processes data. So for you, the listener, trying to build wealth, this stock represents a potential vehicle to capture that massive shift in data center architecture.
Which makes it a very interesting play for growth-oriented wealth building.
Exactly. But, and this is a massive but that we will dig into later, you have to understand the high valuation multiples involved here. You are paying a heavy premium today for that expected future growth.
That makes perfect sense. You're buying into the absolute bedrock layer of the future economy, but you're definitely paying a premium for the privilege of getting in.
That gives us the bigger picture.
Yep.
Now let's look at the fundamentals.
Yeah, let's get into the actual numbers, because their Q1 2025 financial health is where this story gets incredibly interesting. We aren't just talking about a good quarter here.
No, not at all.
The company reported a record $7.4 billion in revenue. That is up 36% year over year.
Huge numbers.
But what really stands out to me isn't just the top line number, it's where that money is coming from. It's anchored heavily by the data center segment, which brought in $2.3 billion all on its own.
And the driving force behind that $2.3 billion is the surging, just almost insatiable demand for their Instinct MI300X GPUs. That is their flagship AI accelerator.
Right.
But, you know, as any seasoned investor knows, revenue without healthy margins doesn't actually build long-term shareholder wealth. So let's look at their profitability.
Let's do it.
Their gross margin for the trailing 12 months is sitting at a robust 50.28%.
I'm going to pause on that because a 50% gross margin is massive for a company that actually manufactures physical hardware.
It's unheard of for most hardware companies.
Right. We aren't talking about a software company where copying code costs $0. They're building incredibly complex physical chips.
It is massive. And the reason they can command a 50% margin comes down to a favorable mix shift.
Meaning what, exactly?
What that means is they are selling a much higher volume of these hyper-expensive, high-margin AI accelerators to data centers and proportionately fewer lower-margin consumer electronics, like laptop chips or gaming console.
Ah, okay. That makes sense.
Now, if we look further down the income statement, their net margin currently sits at 13.37%. This is a crucial metric.
Why is that?
Because it shows that even as they pour billions of dollars into research and development to stay competitive, they are effectively absorbing those costs.
Wow.
Because they are selling so many chips at such a high price, that massive R&D budget barely dents their overall profitability.
And we absolutely have to talk about the balance sheet because they have built an absolute fortress here.
They really have.
They are sitting on $5.4 billion in cash and cash equivalents compared to just $1.7 billion in debt.
Which is an amazing position to be in.
Yeah, exactly. For the listener, when a company has that kind of net cash position, they are deeply shielded from macroeconomic volatility. If interest rates stay high or the economy wobbles, they don't really care.
No, they have the dry powder to aggressively reinvest and weather any storm.
Right. That sheer financial strength is what has pushed their market cap to $904.5 billion. They are cementing themselves as a mega cap tech leader.
Absolutely.
But I have to ask, what is the actual moat here? Like, why can't a well-funded startup or another massive tech company just hire some engineers and build these chips themselves?
Well, the moat is incredibly deep, and it basically comes down to two things. Their technological edge, specifically what's called their chiplet architecture, and their open ROCm software ecosystem.
Okay, break that down for us.
Let's start with the hardware. Historically, companies tried to manufacture one giant, perfect piece of silicon, but this company pivoted to manufacturing smaller pieces, chiplets, and stitching them together.
Okay, wait, let me try an analogy here to see if I have this right.
Go for it.
It's kind of like the difference between building a modular home versus pouring a single, massive monolithic concrete foundation.
Okay, yeah.
If you pour a giant concrete foundation and there's a single crack right in the middle, the whole thing is ruined. You have to scrap it and start over, which costs a fortune.
Exactly.
But if you build modular rooms in a factory and snap them together on site, it's way more cost effective. If one room has a defect, you just throw out that one room, not the whole house. Plus, you can scale the size of the house much easier by just snapping on more rooms.
That is a phenomenal way to visualize it. In semiconductor manufacturing, if a speck of dust lands on a massive monolithic chip during production, that entire expensive chip goes straight in the trash.
Wow, just from a speck of dust.
Yeah. But with this modular chiplet approach, if one tiny block is defective, they just swap it out for a good one. It increases their manufacturing yield dramatically and allows them to scale compute performance far more cost-effectively than monolithic designs.
That is brilliant.
It is. But the second and arguably more important part of that moat is their ROCM software. This is where it gets fascinating.
Okay, why?
Historically, their main competitor had a complete ironclad monopoly on the software side. They built a walled garden that locked developers into their ecosystem.
Right, which makes it hard to switch.
Exactly.
Uh-huh.
But this company's open ROCM software ecosystem is rapidly closing that gap. It gives the hyperscalers a much-needed escape hatch.
And they want that.
Believe me, these massive cloud providers do not want to be entirely dependent on a single vendor for their most critical infrastructure. They want a strong second option to negotiate prices, and this company's open software is finally giving them that leverage.
That gives us the business picture. Now let's move to the Catalyst timeline.
If we look out over the next 3 months, we have a very clear, very exciting map of events. The biggest, most imminent catalyst is their Q2 2025 earnings report, which is expected in late July or early August.
And what specifically are we looking for in that report? Are we just hoping they beat the consensus revenue estimates for the quarter that just ended?
Actually, no. It's less about the backward-looking revenue and almost entirely about the forward-looking guidance, specifically in that critical data center segment.
Right, the market always looks ahead.
Exactly. In this sector, the market is always looking 6 months into the future. Any upward revision in their data center guidance could be absolutely explosive for the stock price.
Oh, wow.
The market desperately wants to see that the backlog of orders for these AI chips is growing and actively translating into confirmed, guaranteed future revenue.
And there are also some specific product and macro tailwinds happening right in this same window, right?
Yes, definitely. We are expecting mid-year updates on their ROCM software stack, which we just discussed. Any improvement there makes their chips vastly more appealing to developers.
Makes sense.
We are also expecting crucial production timelines for their next-generation chips, the MI350 and MI400 series. And on top of that company-specific news, there's a broad macroeconomic rotation happening.
The kind of rotation.
We are seeing major institutional capital flow out of software and aggressively rotate back into hardware and infrastructure plays across the entire tech sector.
Okay, I have to jump in with some serious skepticism here, because this is where a lot of retail investors get burned.
Let's hear it.
The stock is up 155% year to date. It's up 295% over the last 52 weeks. It has essentially tripled. Aren't all of these catalysts, the upcoming earnings, the new next-gen chips, the software updates, already fully priced in by the market?
It's a valid concern.
When a stock runs that hard, it feels like absolute perfection is already assumed in the current price.
That is a very fair point, and it's exactly why forward guidance is the true catalyst here. You're right, the current stock price fully reflects the known demand. A catalyst, by definition, has to be new information that the market hasn't modeled yet. If they come out in Q2 and say, actually, our hyperscaler demand for the rest of the year is 20% higher than we previously projected, that is not priced in.
That makes sense.
That is brand new money entering the equation, and that is what forces Wall Street analysts to frantically upgrade their price targets. Catalysts tell us what could change the story. Now let's pivot to the chart.
Let's talk price structure, because this is where the rubber meets the road. The stock is currently trading at $557.89, which is up about 2% on the day.
Yeah.
And like we mentioned at the very beginning of the deep dive, it is deeply entrenched in a massive breakout zone, hovering just 4.6% off the 52-week high of $584.73.
The momentum and volume here are really the key components of the technical story. We already talked about the 146% 13-week return and the incredible 295% 52-week run.
Insane numbers.
But what is absolutely crucial for listeners to understand is how the stock is behaving right now at these elevated levels. The current trading volume is actually running at 0.86 times its daily average.
Stop right there and explain why that matters. Usually when people hear that volume is dropping off, they assume the market is losing interest and the rally is dying.
Okay, yeah.
Why is low volume a good thing in this specific scenario?
It's all about supply and demand during a consolidation phase. After a stock triples in value, human nature dictates that people are going to take profits.
Of course.
But lower volume here is exactly what you want to see because it means the stock is healthily digesting its massive run on very tightly controlled volume. There is no institutional panic selling.
Ah, I see.
Right, there is no desperate rush for the exits. The sellers have essentially dried up and the stock is coiling. It's literally storing up kinetic energy for a potential breakout test of that resistance level. The buyers are just waiting for the sellers to exhaust themselves.
And mapping out those exact support and resistance levels, finding those specific breakout zones while the volume tightly coils, that is exactly why active traders look for clean, visual charting workflows.
Oh, absolutely.
It's incredibly hard to spot a low-volume consolidation phase if your chart is cluttered with 100 different messy indicators, which is exactly why having intuitive visual tools that highlight those zones is so critical for market awareness. So the chart gives us price structure, but what does market sentiment look like?
The quantitative sentiment picture right now is overwhelmingly bullish. Let's step back and look at the broader market narrative driving that sentiment.
Okay.
First, we have Meta's AI infrastructure spending. Mark Zuckerberg recently reframed their massive capital expenditure as a direct revenue driver rather than just an R&D cost.
Which is a big shift in perspective.
That is a massive green light for the whole industry. It fundamentally validates the total addressable market for these AI chips. We also saw a recent aggressive jump in Micron's stock price, which improved sentiment across the entire hardware supply chain.
Because memory chips go hand in hand with AI compute processors, right?
Exactly.
And I saw there was a fascinating comment from the Cerebras CEO recently, publicly confirming that they have $25 billion in AI backlogs that are fully booked.
Yes.
Not projected, not estimated in a spreadsheet, but physically booked. That tells you this data center demand is very real and locked in across the industry.
Exactly. The money is already committed. And then you have the speculative rumors, which are always swirling in this high beta sector.
What are the rumors saying?
There's a lot of unconfirmed chatter right now that this company might secure a massive multi-year custom silicon partnership with a top-tier hyperscaler.
Oh, wow.
Yeah, if they are secretly co-designing future AI architectures hand in hand with one of the big cloud providers, that fundamentally transforms their long-term revenue visibility from a guessing game into a guaranteed multi-year cash flow stream.
Okay, but I want to flag something that is going to look like a massive red flag to anyone scanning the data. We have to talk about the insider flow.
Yeah, that's fair.
We are seeing some very heavy insider selling. Over the last 90 days, insiders have net sold 407,494 shares.
It's a lot of shares.
And the insider multi-sector pacing ratio, which measures buying versus selling pressure from executives, is sitting at a deeply negative 93.39.
Right.
That means for every 100 shares transacted, over 93 were sold. If this company is the foundational bedrock of the AI revolution, and the story is this incredibly good, why are the executives aggressively dumping their own shares? Are they just cashing in at the top?
It's a very important metric to watch, and I understand why it alarms people, but we have to thoroughly contextualize it.
Okay, how so?
When a stock has a 295% run in a single 12-month period, executive profit-taking isn't a red flag, it's completely standard.
Really?
You have to remember, these are executives whose personal net worth is heavily, dangerously concentrated in their own company stock through restricted stock units, or RSUs.
Right, that makes sense.
Selling a portion of their holdings after a historic, life-changing rally to diversify their personal portfolios or pay massive tax bills is just normal financial planning. A negative 93 pacing ratio sounds scary, but it doesn't inherently mean the underlying business is failing or that the C-suite has lost confidence.
Yeah.
It just means the stock literally tripled and human beings are cashing some chips in to lock in generational wealth. That sentiment picture is useful, but we still need to talk about the risks.
Yes, we do. And we need to lean heavily into the valuation risk because this is where extreme caution really comes into play.
Definitely.
The trailing price-to-earnings ratio is currently sitting at 180.58. Just to put that in perspective for you, the listener, a normal value stock might have a PE of 15.
Right.
This is 180. The price to sales ratio is 24.15. That means the market is valuing this company not based on the money it is making today, but based on a massive, uninterrupted runway of flawless future growth.
It is priced for absolute perfection. There is zero margin for error built into that stock price.
Zero.
And when you are priced for perfection, any slight let's say a minor delay in shipments, a sudden supply chain hiccup, or forward guidance that is just good instead of great, that could cause severe multiple compression.
Which means what for the listener?
What multiple compression means is that the stock price could fall dramatically even if the underlying business is still generally doing well and growing, simply because that massive premium valuation gets wiped out by disappointed investors.
It's exactly like driving a multi-million-dollar hypercar. When you pay millions for a hypercar, you expect flawless, mind-bending performance every single time you start the engine.
Exactly.
The market won't forgive even a slightly flickering check engine light, one little sputter on an earnings call, and the value tanks.
That's exactly right. You are driving at 200 miles an hour, so any bump in the road is magnified. And the other major existential risk here is long-term competitive pressure.
Who is the competition?
Well, we already know their primary competitor has a dominant, entrenched market share, but the more insidious long-term threat is actually the hyperscalers themselves.
Like insourcing?
Yes, we talked earlier about Meta insourcing compute with their own custom AI chips. Google has their tensor processing units. If the biggest buyers in the world decide it's cheaper to just design and build their own custom silicon internally, that eventually shrinks the total addressable market for merchant silicon providers.
It's a huge risk.
They could find themselves slowly squeezed out of the very multi-billion-dollar market they are currently helping to build.
So with everything on the table, what's the final verdict?
Based on the phenomenal fundamental growth and the coiled technical setups we've discussed today, we are looking at a bullish score of 8 out of 10.
8 out of 10, okay.
The ultimate summary here is that the company is successfully leveraging its highly efficient modular chiplet architecture and its robust 50% gross margins to capture a very real, very lucrative share of the generative AI infrastructure build-out. Looking at the immediate target horizon, it reveals a deeply compelling momentum setup heading into that critical Q2 2025 earnings report. If they deliver an upward revision in data center guidance, this setup could easily transition from a short-term momentum swing trade into a rock-solid, multi-year investment thesis.
Just something provocative to think about before we wrap up. If that unconfirmed rumor about a massive custom silicon partnership is actually true, it really makes you wonder. At what point does being a simple hardware vendor end and being an invisible, indispensable partner in the world's biggest AI brains begin?
It's a fascinating thought.
Keep a very close eye on those hyperscaler contracts moving forward. But, as always, I have to strongly remind you that this discussion is strictly for educational purposes. It is not financial advice.
Yes, absolutely.
We are not telling anyone to buy, sell, or hold this stock or any other asset. The market is incredibly dynamic and unforgiving, and you must do your own independent research and heavily manage your own risk before making any investment decisions.
Perfectly said.
And finally, if you want a cleaner, more visual way to read trading charts and map out the breakout zones we talked about today, check out VIP Algos through the link below in the description.
Highly recommend it.
VIP Algos is a comprehensive TradingView indicator suite featuring visual buy and sell alerts, trend direction tools, support and resistance zones, and clear planning areas. It can genuinely help make complex charts easier to scan and understand, but remember, it is still only an educational chart analysis tool.
Right.
It is not financial advice, it does not place trades for you, and it absolutely does not guarantee results. Trading involves risk, so always do your own research and manage your risk appropriately. This is an affiliate link, and we may earn a commission if you use it at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.